Welcome to the MHP Exchange podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
And we're back on the MHP Exchange podcast. Joining me today is my partner, our CFO, Peter Falcone. Peter, this is your second appearance on the MHP Exchange podcast. Nice to see you out of your office and not face down into your computer, just looking at numbers. How are you today?
Yeah, good. I mean, I think you guys kind of realized, I'm the more attractive one, and, I bring the views to the episode. So, I appreciate your enlightenment there.
And Peter is trying to crack jokes in the morning, and this is why he's typically face down into the computer. So I appreciate you being part of this episode, and we love talking about deals here. We love talking about how looking into the MHP space, hearing how people are structuring their deals, how to look at an opportunity, and how to bring value out of your park or your real estate investment, specifically in the manufactured housing space. And we just closed our largest deal to date, a very important deal for us in our portfolio and really in the trajectory of where we're going. And we're going to walk through the acquisition of Patriot Place. So if you're out there and you're looking at a deal right now, this is something that you'll probably want to take some notes on. And then if you have questions, we'd love to hear your feedback on this as well. But we just closed on Patriot Place, which is in Onslow County, North Carolina. It's in Hubert, specifically in the city of Hubert. It is a 271 lot community, had 91 lots which were rented. So there's a huge value add and infill component to it. We acquired the property for $5.175 million. And there's some different layers to it, and we're going to go through that today. We're going to walk you through the structure. Inside that deal, we acquired 39 park-owned homes and 24 homes which were encumbered with relatively new homes, but encumbered with a manufacturer. So Pete, did I miss any of the high-level 40,000 square foot look at the deal?
No, just a little around the edges.
A little around the edges. And Pete's reason for being here is because he goes around the edges and really fine-tunes that detail for us, which is an important component. I mean, especially, if you're taking your business seriously, you need to be able to do that, right? Because it's those edges which makes all that gravy, right?
Yeah, or could sink a deal. Yeah.
Could absolutely sink a deal. So, and before we get started, right, and we go into, the deal and the structure and some of the economics that we were looking at and how we laid this out, I'm going to give some backstory. Do you mind if I do that?
No, I think the backstory is actually a key part of the deal.
It's a huge part. Mm-hmm. So we've been working on this deal almost 2 years by the time we closed it. And the reason why it was so long is we had initially been in contract with the park next door. So first got alerted to the community next door, which was an 86 unit multi-generational property. The original owner's lineage, like the grandson was managing and operating the park, actually lived there. So when that was introduced to me from somebody on our team, it was an 86 unit community across 75 acres. Initially, it struck our interest, right? And we started to look at that deal. And then as we do, especially when we go into a market and we look at one deal, we make it a point of looking at the other communities in and around that market that we're buying, right? And Pete's always drilling in whenever we're looking at a property to make sure, as a reminder, that we have checked every single park in the area.
Yeah, I mean, it's important, right? It's not only an economic indicator, but we want to see what your competition is, right?
Correct. And in doing so, we saw that there was a park next door. So we go into contract on originally called Ramsey's Mobile Home Park, and the park next door is called Patriot Place. So initially we're out there, we're calling, we're getting comps, because that obviously is going to be the closest rental comp that you have. But we're also trying to get a little bit of the backstory in and around that deal. And apparently the owner there had some, he had owned the park for 10 years. And he was actually open to the idea of selling the park as well. But there was actually an interesting component to Patriot Place, why it was next door. The park, Patriot Place, and Ramsey's was at one point one. It was one community that gentleman had built, and he had two sons, and he did what people do sometimes, figured the easiest way to split up the community between the two sons was to divide it in half.
I think we know which son was probably the baby.
Well, yes, you could maybe take a look at that, but we don't know what it looked like at that point. But he did split it in half. And the Ramsey's Mobile Home Park was part of the original owner, and it looked like that community had not seen any capital improvements or maintenance done in decades. As a matter of fact, one of the things that was very intriguing, or to me anyway, is that when you went there to see the park, the sign was literally hanging by a thread and on its side, and had been there for about 15 years. And the grandson had just no motivation to fix it, which just was bizarre. But Patriot Place wasn't like that. In looking at Patriot Place, I mean, I know these communities get rated as like a 1 to 5 star park. I mean, where would you place Patriot Place in that spectrum?
I would put it close to, probably 2.5, 3, maybe 3.
I think that's right. Probably closer to 3, but Ramsey's is definitely a 1 star.
Yeah, I mean, if it's even on that scale.
So our initial conversation with the owner, who had purchased Patriot Place from the family probably about 10 years prior, and he made some improvements, paved the roads, brought in some newer homes, cleaned up the park. His number initially to me was $9 million, which was just, I just thought was an astronomical number. And I know he had some interest, because that's what he kept telling me, I have some interest. Our number was in the mid 5s without really doing a deep dive in terms of what he had there. And we just told him to stay in touch. And we went through our purchase of American Way. So now, or Ramsey's actually. So
Which is now
American Way. So funny, interesting story on that. So now we know that we have a competitor that's Patriot Place. We're in a military town, Jacksonville, North Carolina. Camp Lejeune is across the highway from us. So we're very close by to throw a baseball. Well, I can throw a baseball because I am a fine physical specimen. At maybe halfway.
Well, that's because I probably throw it over.
Okay. So we buy Ramsey's, and we realize that we're going to invest money to, number one, bring in some new homes, number two, do some major infrastructure work. What happened? We shut down?
Hold on.
Or got along now?
We're back.
So as we're doing the work at Ramsey's, we realized we got to change the name, we're rebranding it, and being that Patriot Place was there, we changed the name to American Way. But we stayed in touch with the owner of Patriot Place. We just wanted to track what was happening, and he did mention that he had an offer at $7 million, which fell apart. He had an offer at $6 million, which fell apart. And then finally, when he had an offer, was ready to have the conversation with us, In the mid fives, we started opening up that dialogue again to see if the deal would work or make sense. So, a couple of things in knowing that we knew the market, right? We got very, very comfortable with Onslow County very fast, right? So we did a lot of market research before. We knew the county was growing. I mean, there's 70,000. It's an MSA with 204,000 people, 70,000 people expected there in the next 20 years. It's the 11th fastest county inside of North Carolina. So I mean, it had a lot of the metrics in there that we knew. We knew exactly who the other players were in that market space, and we know what the average rents are going for, where the average lot rents are going for. So having that market knowledge allowed us to be able to make decisions pretty quickly if that's a place we want to grow and expand in, right? So even though we're in various states, we really operate inside of hubs there, right? We're not spread out. We're more focused on, we find an area, we find the market. Now let's get scale inside that market, right? And I think that in this space, it's more, that is like a key element to being successful in the MHP space.
Yeah, no, it's true. I mean, you have to look at the bigger picture. When you're going in there buying assets, is this a place you want to be? But I think Patriot Place and American Way is just such a unique deal that we've done that we still need to we still need to finish doing what we're doing, but the end result is just going to be something phenomenal.
Yeah, and on the scale, I mean, when you're talking about an industry that's specific in the MHP space, this is a business really of nickels and dimes, right? And things can get away from you real fast. One of the ways that you create value is by creating efficiencies inside the communities you own. And when you own multiple communities in a geographic region, you can share costs, right? And I mean, you've got, Pete, comes from the debt world where he was dealing with CMBS and on large scale transactions across the board in the investment banking world. It's specifically in the space, right? So that having that scale and that efficiency, what does that do for a portfolio? Like, what does that do for a valuation on a property?
Yeah, and while I was at my last stop, which was JP Morgan, we did a balance sheet loan that had a couple of components to it, and so the biggest thing was, actually, sorry, step back a little bit, we refinanced quite a few large portfolios, and I don't mean, 10 properties, we're talking hundreds of properties each, but the biggest thing that's, important, right, is the scale. And the scale allows you to sell with the portfolio premium. It also gives you, and just to kind of describe what a portfolio premium is, it's a premium on top of the aggregate value of your properties, right? So if each property is worth $10 and you got 10 of them, it's $100, but you'll probably sell that portfolio for about $107 or $108. And the other thing that it gives you is geographical synergies, operational synergies, and that is probably arguably more important.
Absolutely, because getting the biggest challenge in any business, right? It's the people and getting the right people to work. And so when you have the ability operationally to leverage those people into multiple situations, you can become more efficient in your operations, in your unit turns, in getting to where you need to be quicker because you already have the team in place.
And it's not just the people, right? It's pricing power. The more properties, the more units that you need. Right? So, for example, for homes, we have pricing power.
Correct.
We need to order more homes. And, if I had one park and there was only 3 homes, well, guess what? Just Patriot Place alone, we got to order 140.
So, that's correct. And then when we went back into this deal, and I think one of the things that gave us a lot of confidence that the seller was always going to come back to us, because when we were going to Ramsey's, there was other people interested in Patriot Place. So someone could have technically did what we did. And I think and we actually met with one of I met with one of the individuals who was interested in doing what we did which is rejoining both of those parks together. And their approach was to take the larger one, which was Patriot, and then look at American Way, right, or Ramsey's at the time. And our approach was opposite. And why we felt confident in that is that we realized that and this sometimes you get lucky, right? We realized that when we were buying Ramsey's, there was something in the deed, a restrictive covenant that allowed Ramsey's to utilize the neighboring property. And that was causing an expense, which would be an unrealized expense to the park property next door. And it would go on forever, right?
Yeah.
So if you were going to buy Patriot Place, we would have the ability to utilize that property, which could run, because it was a utility expense that could run somewhere between 50 to 60 to maybe even $100,000 a year, that you wouldn't be able to recoup that cost. So we knew by controlling that property next door, we actually, eventually, that seller would have to deal with us, right?
We were in the driver's seat.
We were in the driver's seat. So that was by chance. It wasn't something that we specifically designed, but that's one of the reasons why we knew the market, we knew where we wanted to be, and we knew where our number was fair. So when they finally came back to re-engage with us almost a year later, saying, okay, now we're ready to talk. Now our numbers seemed a lot more realistic. And we were able to have that dialogue with the seller of where we needed to be. So when we looked at the numbers, their top line number there was pretty strong. I think
It was about 700,000.
So a little over $700,000 a year in gross income. But their model was a little different. Like their homes, they're park-owned homes. They run a rental model, and their average rents over there were.
Well, for the park-owned homes, it's about 30-ish.
And then the lot rent was at $404. Now these are important numbers, and this is why you need to know this, right? So we know in that market that a park-owned home, if to rent it, which we don't rent, but we know that the comparable rent price is $1,175 to $1,200 a month, right? So there's runway there. But more importantly, communities in that, the lot rent is $525, which is a neighboring property. And if they have amenities like real in-ground pool, playgrounds, you can get upwards of $550 a month or better, which essentially gives us a 35% runway on lot rent, with not just existing residents, but on the infill. So we could look at, if we bring in amenities, we could look at market, and we know that we have a 35% increase from where we are currently, right? And how important is that in looking at the facts?
It's extremely important, right? Because other operators in the region, or specifically by Jacksonville, are major institutions. And when you're really honing into where you could bring your rents to market, it's important that there is a baseline of rent comparables. And you can't just have one park, you need to have multiple parks, because one park could be skimming the numbers for various reasons, whether they're legal or not, or I should say moral or not. However, it's important to understand when you're underwriting these things, where is my revenue today and where is my revenue going today?
Yes, and the interesting part about this, right, on the revenue front, when we looked at this acquisition, and it's funny to say that it's at $700,000 plus $700,000 gross income that's coming into that community, but it's value add, right? Like this was just skimming the surface, because essentially we're at 45% occupancy, physical occupancy, and we still have runway for growth. So for us, we typically don't acquire a property with value add that already has that type of income component, and it was profitable, right? And the property was already currently showing a positive net operating income. However, their OPEX charges were completely out of whack.
There were so many items in there that just made no sense.
They were running at about a little over 50% operating expense ratio. So for every dollar coming in, about 55 cents was going out for expenses. We already knew that number could be condensed, especially owning the property next door, right? we get some efficiencies there. But we also knew that there was runway for growth inside of where everything was priced. Now, the challenge in this, though, we also knew that because we have a value add park, that cash flow we need to reinvest into the property, right? So the first stage in structuring this deal correctly was we know that we can't go to the market and get debt because the cash flow that this was generating, which was over $300,000 a year in cash flow, we have to reinvest into that property to infill to get it to stabilization, right? So this is where we have to start getting creative.
Well, there's also the fact that the 23 of the park components were covered by a lease by a housing manufacturer, right? So that was one of the items that we really needed to dig into, and it was very interesting why the prior owner engaged in that contract. Not exactly sure, but that was as one of the items that we're maneuvering around as we speak.
Correct. And I think it's because of whatever his reasoning is, we know we needed the cash flow to reinvest into the community.
And that's $108,000 a year.
Yeah. And so what we did was to engage with the seller. And now that he knew that we were the natural buyers and we were serious, we were committed to the market. He'd already seen some improvements we made at the other communities, so we knew that we were serious about execution. Now we could start talking about creative seller financing, and so getting to understand what his tax liability would be, right, and his.
Don't even have me go down that path right now.
But,
I don't want PTSD.
Yeah, but understanding what his situation was, and then structuring a deal that works for the deal itself. And we got creative with it, where right now when we started putting this deal together, rates were sitting in the high 7s, low 8s, right? So we were able to negotiate 6.5% rate on the loan, which was great. So seller financing at 6.5%. But an interesting component to this was we were able to get a deferral, right? So the seller was very specific. We really wanted the interest rate to be lower to make the deal work. The seller was understanding where real inflation was, and the factor was that, look, I could take that money and I could put it into the bank and get 6%, which was a reality. You can get 5.5%, 6% there, and they are looking at seller financing. So to ask them to hold a note at 3% in a market where you can go to the bank and get 5 or 6% is a little bit of that's a tall order to ask. But we were able to structure something that could work for us in the current and work for him in the long term, which was he didn't necessarily need the cash to survive, but he just wanted to make sure he wasn't losing money. So we were able to negotiate a deferral for 300 basis points for the term of the mortgage, which was a pretty substantial, I thought, give for us, and gives us the time we need over the next 5 years to get the property stabilized.
Right. And we were able to use that lease, in those negotiations, because that ate up a large portion of cash.
And because now we realize that this stabilized valuation of just Patriot Place, so if we get, we have an infill component here, but if we get this to 180 lots filled over the next 4 years, Pete, up there, what kind of valuation would we be looking at this park?
I mean, if we're going to fill in 180 lots, we're probably looking in the high teens. Now, the expansion component is the element, right?
Without even getting to the additional 71. So if we get, 180, so we basically infill 100 lots over the next 4 years, we're probably looking at a $16 to $17 million valuation of the property, bare minimum, right? And that conservatively. And so for us to defer 3%, which essentially equates to $300,000, right, doesn't really impact us as much as having that additional cash flow to reinvest into the property now. So I think that was the first key component, is getting that debt. So number one, we got the pricing that we needed, which was under that under 5.2, which was important to us. And then number 2, which was getting the terms we needed in creatively financing with the seller, which wasn't a one call conversation. I mean, you had conversation with them, I had conversation with them, and I think we negotiated that in the summer. I remember I was sitting outside in my yard and had an hour and a half conversation with the seller, going over the game plan, how we looked at this, and then he bought into that vision, and so he's vested with us, and he's gonna obviously during the term of it, if we execute, he'll get what he wants, and he'll get a little bit more on the way out. But for us, it works because it allows us to kind of execute the business plan.
Yep. Yeah. I mean, this whole deal was very creative, and it's not a risky creative. It works for everybody creative.
Correct. And this is what you have to do sometimes when you're in the value add spaces. You have to figure out creatively how to make the numbers work. So now we have the big picture vision of where we expect this community to be. We have a price that we know that we can work at. We have terms that we know are reasonable and we can live with. And now that this is where Pete really is at his best, because Eric and I will come up with a vision for the property, and now Pete's the guy that we have to sit down with and make sure that those numbers jive, and we have a plan of execution with milestones and timelines to hit. So let's talk about a little bit about what that process is like after we're at that point. Like, where do we how do you go about with us reviewing that and making sure that we're executing correctly and that we're setting up timelines that make sense in your underwriting process?
Right. So, I think it all starts with when we actually get the deal in before we have the contract. And, that's when we underwrite the deal. We have a proprietary model that, we put together for specifically what we did, right? And it really does factor in just about everything. And so we take a quick 30,000 view of the property, in underwriting. Hey, does it work? Okay, it actually makes sense to spend more time on this. So we really drill down, get into the details, but what we know at the time. And so we also knew it worked again once we did that. So once we wrote the contract, me and Eric went down, singing the songs all the way down to the property. Did your diligence space, a week down there, it was, so a few days, and came back with the operational plan. So once you came back, we all sat down. You gave me your report. The 3 of us kind of discussed the different things that could happen there. We put together the capital improvements budget, which is important because you need to know what's got to get on that property and what's nice to have. So your needs and nice to have.
Well, and I think that's one of your key components of what you bring to the table here. There's a vision that you have as an operator. Like, I would love to do X, Y, and Z, right? So A, B, C, D, all the way to Z, right? And so we have this entire list, and then it's, do you need to have it? Do you want to have it? And then what's the value of bringing it in? So it's not a question of that you don't do it. It's just maybe you just don't do it right now. What is going to have the highest impact right now that's going to drive the biggest return, especially when you're looking to execute on a value add plan? And so because we do have timelines, and you have investor expectations that you need to meet, and you have timelines that you want to meet maybe on your debt service or on where you want to return capital. So you have to phase that out correctly. And one of your strong points, quite frankly, and it's from your experience at JP Morgan, is the need to, want to, in return, and understanding that in the CapEx plan and why you do it. I'll give you a perfect example, not that I'm going to skip up. Obviously, there's a lot of space on 75 acres, and there's absolute some lots that we know that we could infill. But in having this plan and conversation with you, we realized that if we did the entire tree plan in the first phase, there's a certain amount of lots that need some infrastructure, water, sewer connections, and pedestals, and so we would be if we remove the trees right now, where there's no homes, there's no hazards, there's nothing there. But if we did all that work right now and we weren't ready to infill, we would absorb this cost without necessarily getting a return.
Right.
So we're able to stage it out better, to stage out the
Not to
capital.
mention nature's going to take over again, so it's only additional cost in the future. But, I think when we sit down and discuss this stuff, Eric's running in, market rents are, 550. All right, we'll get into that in a little bit, right? And we need to know why they're 550. And so, we sit down, we talk about the plan, and it's okay, we start with the infrastructure, the needs. And so, okay, there's some water pressure problems, okay. Write that down. How are the roads? So roads always a major cost. How are the current pads or the lots there? And, there's the infrastructure there, the pads there, the pedestals, etc. And we actually take inventory of what needs to be replaced. And, we're very experienced, so we know the cost to replace these things, especially given that we're doing it right next door. So we sit there and we put a very detailed capital improvements plan together. And while we're doing that, we also consider timelines. What can be done at once, right? How many things can we run parallel at the same time? And what needs to happen before we get advanced to the next step of the capital improvements plan. And to your point earlier, let's say, and just an example, but if we have to, do the infrastructure for 100 pads, why are we going to do it all right at once? Because by the time we get to build that 100th pad, it might be, 2 years down the line or 3 years down the line. So that's something that you have to think about. So, okay, let's do it in phases, right? Keep the cost to minimum while we can, because your return on invested capital, your ROI, is important. So, especially with cash flow, right? If you have debt.
And so that's a great point. So we sit down and we go through this and this exercise multiple times, right? And to ensure that we're comfortable with a timeline, that we understand exactly what our anticipated costs are. And then we also look inside that community of, where there's some additional value. So we are, obviously we talked about the newer homes, but we also had some park-owned homes there, which have, if you're looking in this space, those park-owned homes, I know there's some people out there that says, I don't want to buy any park-owned homes, but if you're buying a community that has some later model homes, they have an intrinsic value. So they have an NADA value, they have a value, a blue book value that it's worth inside the community. We knew inside that community, inside that acquisition, there was over $600,000 of home value in there. Now we can pull out some of that value through a myriad of ways, whether it's a bulk sale or financing on those homes, and we're going to be able to use that capital to reinvest into the community as well. So we have a very robust CapEx plan for that first phase, right, to get that community to where it's quasi-stabilized, at least normalized, right, where we've got that infill done. But we're looking at the levers inside that community that we can pull, that we can capitalize on to reinvest, right? So that increases our return on investor capital.
Yeah, and it's very important to know when you need to recycle capital and when you don't need to recycle capital. The more money you put into a deal up front, right, drags down your returns. Why? Because you invest more capital, right? So your return on invested capital stinks. There's different things to think about when you're doing that. In this deal specifically, not only did we have the value of those park-owned homes, which we could sell, even some of them at a fraction if we really needed to. But we also had, the implied valuation in the homes that are encumbered by the lease too. But first, you have to buy out the lease in order to realize the asset value, which is also part of our plan. But I guess coming back to, the needs and the wants, there's something that's in the middle, right, which is amenities. And their wants, but there are also needs in certain instances. And Patriot Place is a good example where it's a need. So when I was talking earlier about market rents being 550, well, why? And what was the big factor in those communities? They had pools, right? Pools, clubhouses, some are nicer than others, and I think what we have is going to be a very nice, design. sometimes playgrounds, parks, and that's what allows you to, bring those rents to market. So you have to look at where your market rent is without these amenities, and then you have to look at what your market rent is with the amenities, and factor in the additional capital costs to bring your community to that new market rent. And if it's creative, then it's worth it.
And that's a great point, because the first thing we realized is that having an amenity package there was going to be extremely important. Now, we also own the community next door, which is 86 lots, and we're in the process of an expansion there, which would mirror what we have at Patriot Place, which would be over 200 lots. We realized in doing that, you're going to have a community like that. You need to have, especially in a market where you can see 550 or greater lot rent, that it commands having an in-ground pool. It commands having a playground, a dog park, a dog walk. These are things that this type of community commands. Now, the added advantage of having the community right next door, we don't have to put in two pools. We don't have to put in two different amenity centers. We only have to do one, and that could be borne on the cost on both communities. So in essence, in doing that community package and having that synergy and having that scale in that one location, it drives down our cost. So now one of the first things we're doing is we are putting in the community pool, which will start construction, and as soon as the weather breaks and as soon as we're able to do that, that obviously allows us to bring in new people at that community at market. The legacy residents, meaning the residents that have been there, we don't want to create any payment shock to them, right? That all of a sudden their lot rent is going up 35%, even though we have these amenities. However, we know that new people coming in are willing to pay market, right? And that's where we sit down and we have to gauge, like, what's our lease up? Like, what's the velocity that we can get people into that community, and where we see that market trend going. And I know you and I go back and forth on that, but do you have a standard in terms of setting expectations that are aggressive, right, to keep us under the gun, but also realistic, right? We don't want to say, let's face it, we have 100 lots to fill. We're not going to do that in 6 months, right? Like, so how do you judge, and how do you use that as a guiding post? So if you're trying to underwrite a deal, we're not setting unrealistic expectations for ourselves or our investor capital.
Right. I think it's multi-pronged, and it's something that, both of us and Eric, and, always learning. And by doing that is a good thing, right? We know so much already, but if you're not learning and growing, then you're never getting anywhere, right? There's nobody out there that knows everything. But as we've learned from past experiences, right? It's what is the market's buying power and the market support numbers? Yes, okay, great. That's number one. But the other thing is lease up and leasing velocity. When we factor that in, we take into place the current inventory, and then we take into place our sales trajectory, right? What's happening at American Way right now? It's basically a case study for what we're doing. And so we could take, now that we have proven sales there from this year, we could take that sales velocity and apply it to Patriot Place.
And a key point, and we go back on forth on this, is that we also know how many sales are happening inside that market, right? So we're very conscious of the market in general, the median sell price of traditional built homes, and where that value proposition is. And then we also look at, so we're very much, right, we don't look at, especially when you're in value add, I don't think cap rate is as important to us as, maybe our basis in terms of where we are per lot.
You need your entry cap.
Yeah, our entry cap rate. We're always looking at what our yield on cost is going to be, right? After 24 months, after we stabilize that property, right? That's a very important metric. But on entry cap rate, we're not, because if our entry price is correct, and we can underwrite the cost of the setup of bringing in new homes, and there's still a value in there, then we can see if that works. So this is what makes the MHP space a little bit different than, say, buying traditional, multifamily. Like, you have to understand these different metrics to see if the numbers work, all line in. And we realize that where that market is, and to your point, we already in that market, so we have a good testing. Like, we've done our testing in there. We know what that market velocity is. We understand what the lease up is. And we've been very fortunate at American Way. Our sales team there has done very, very well in a very short period of time, that we already knew the dynamics of where we can go, and we could set expectations reasonably, like undercut where we were, to see exactly what this would look like in terms of return over the next 48 to 60 months. So now that we've gone through that process, I mean, anything that you saw that in the capital stack that we did that was interesting or intriguing, or looking at that deal, like anything that you noticed that in structuring it that made it kind of unique or special?
Yeah, so I think that the cap stack of the property is unique, and not for any specific reasons, but so we have our common equity, and then we also have our debt, right? But more importantly, we also have our preferred equity. And the preferred equity is, a group of, long-time investors that wanted to get in on the deal. So we structured them basically as convertible preferred equity. Why did we do that? Well, it's two-pronged approach, and part of it is the fact that they wanted to get in the deal. They were coming in for a significant chunk of the capital stack, and so the way we structured it was, to your point earlier with the mortgage, the seller financing on the property, we structured it deferred pay and current pay. We also structured the waterfall as after conversion, the waterfall flows back towards the other common equity, which is our fund. So that was an important structure, and then the underlying mechanics behind that structure also impacts our business plan, right? Because we need to think about all the different components here. And then we also need to think about how do we get ahead of those components in case anything goes awry in the world. And, that means, let's say there's just an economic collapse, people can't buy homes, etc. What are we doing to prevent anything going wrong? So I think that's what we talked about for a long time.
And what made this unique, and this the type of situation to bring in that difference of cap structure, we knew, right, because of the effect that the neighboring property had. Like, we were able to use that utility systems, which was creating an unrealized liability on Patriot Place, that where in normal markets this may have traded for significantly higher, but for that reason, we already knew there was some intrinsic equity built in, right? So we could take in.
We got it at a huge discount
to replacement cost and to market, because if not for that, this would have traded probably at that $7 million number, right? So in doing so, we know that there's a value add component initially going in the door, because now we've taken away that unrealized liability, right? And in doing so, we could trade some of that equity, right, for capital that's going to allow us to reinvest that cash flow. And it doesn't become a drag on our equity capital now. And if we execute, we're able to get all that back at a higher multiple down the road. So that's where you can get a little bit creative in how you structure your debt and how you structure your equity to make a deal work. And I think now it comes down to execution, which, and if you guys are following, which I know you are, you're definitely going to be hearing about Patriot Place, because combined with American Way, we'll have over 500 units in one location, which is a huge driver in this market. We know in this space, that's less than 1% of the communities nationwide are 500 units or better, which again creates that economies of scale. So, Pete, any last words you might have about Patriot Place?
No, I mean, it's, we've spoken about a lot, you know, we gotta continue to get to work, you know, I'll keep pounding the table, so this needs to get done. But, you know, keep doing what we need to do and everything's gonna be all right.
So I appreciate you coming down and talking about this. And if you're out there, one thing we love talking about on this program is deals. And if you're out there, you have a deal that you want to discuss, you're wondering how you should lay it out, you want to go through that underwriting, reach out to us at stonecapinv.com or send us a message through the MHP Exchange. We'll be happy to get back with you and take a look at your deal and see how we could structure it, how you could best capitalize on what's there so you can have a successful mobile home park investment. Until next time, happy investing.